Hello, I'm Kamila Ramanathan. Welcome to Market Call. Shane Obata is on the show today. He's portfolio manager at Middlefield Capital and will be taking your questions on global and U.S. large cap stocks. Thanks for joining us. Let's bring in Shane Obata for his take on the markets. Thanks so much for joining us, Shane.
Thanks for having me.
Wonderful. Let's start on the big news we got, of course, of U.S. as well as Canadian jobs. The main takeaway for the market is a surprising resilience. Now, I read a little bit before the show about your take on the global economy and where you see sort of the shift in terms of equity activity come November. What does the data today suggest in terms of that growth?
It's a weird situation right now in the sense that we're kind of hoping for weaker economic data in a sense in the States and also to a lesser extent in Canada, in the sense that we want central banks as investors to kind of take their feet off the gas pedals.
Yes.
But the tricky, we are starting to see a pivot, I think, globally, but can make the argument that the Fed is the most important and they've really stayed firm with their hawkish stance. But we do think that following the meeting now and based on what we've seen in the very recent meetings, there's probably some division within the Fed. There was a time not too long ago when every member that was out interviewing would say pretty much the same thing, which was to stay max hawkish until inflation is under control. And now the narrative has sort of shifted towards what we've seen from some of the other central banks doing what we would call a dovish hike or a pivot, in that they're acknowledging that the rapid tightening of monetary policy is going to take time to kind of work its way through the economy. And so therefore we should be a little bit cautious. So we haven't necessarily, sorry, go ahead.
Sorry, I was just going to say, it sounds like you could be suggesting, like a growing consensus of others that are observing the markets, that we could be coming towards the tail end of this rate hiking path.
Well, I think it's early to say that because the economic data has been strong, but I think the market is starting to anticipate a peak that will happen in the near future, and then. But part of the issue right now is that the forward curve that kind of tells you what the market is expecting about rates is projecting that we're going to stay near the high end of the range for most of 2023. So that's a newer development, which is basically to say that we could stay, as things are right now, pretty max restrictive over the next little while. So it's a difficult situation right now.
You know, I remember in the height of the pandemic when people were talking about how transitory some of the supply chain chaos was. And now, if we count from sort of the beginning of the pandemic, we're heading into what could be the third year of a lot of these issues. Magna, in its latest results, also talked about how it was a pronounced headwind for the business. So tell us, how long do you think such an issue is going to remain in the marketplace?
I think I was one of the people that was thinking that some of these issues would get resolved sooner than they had been. I do think there's some truth to the idea that supply chains were basically reconfigured during COVID in order to meet the demand for things that were needed at that time when we were all at home and we were buying TVs and upgrading our PCs and whatnot. And so that kind of shifted capacity away from some of the other stuff. And so I think there is an element of truth there as supply chains ease up, that inflation should come down correspondingly. But I think it's also fair to say that some of this is demand led as well. And you see some of, and that's why I think inflation has been and could continue to be sticky. And we do actually think that the CPI is going to start cooperating a lot more going forward here. But even still, when you have wage growth, for example, that's a stickier form of inflation. That doesn't just go away overnight, right? So I think that's part of the reason that the Fed wants a weaker labor market to kind of alleviate some of the stress there.
Okay, well, I'll be asking you about China and the wrench it throws into sort of global macro development in a second. But first, let's take a question from one of our viewers here. We've got a question from Anthony. He wants to know about Brookfield Infrastructure Partners, TSX listed. Can I have your guest's opinion on the company? Is it a buy?
Yeah, so we like Brookfield as an asset manager, and this is one leg of the stool, of the Brookfield stool. And I think it's a good environment for infrastructure, and that's kind of what we've seen in our research and across our holdings this year. A lot of infrastructure assets are viewed as kind of inflation resistant, in the sense that these are real assets, oftentimes with longer term contracts, whether it's utilities or like classic transportation assets. There is a degree built into the contracts and built in the assets of inflation protection. So I think infrastructure will continue to be an area of interest for investors. And then within infrastructure, Brookfield is a great operator. And I think that at current prices, the stock price isn't accurately reflecting the NAV, which we think is significantly higher. And we would definitely view Brookfield as one of the best operators in this space, in the real asset space. So you have to kind of take a contrary perspective in times such as these, when there's a lot of volatility. That's actually a good setup for these kinds of acquiring companies that are built on acquiring, and in Brookfield's case, acquiring and streamlining, making better, and then selling down. So yeah, this is actually a good environment for them in a weird way. Mm-hmm. And we think that the business is big enough that you can continue cycling capital. These are very disciplined allocators of capital. And so when something becomes fairly valued or overvalued in their mind, they will sell it and they will recycle the proceeds into something that they think is cheaper. So that can continue on. So I actually do think it's a good setup for this company right now.
Okay. Next, we've got a question from John about Disney. What's your evaluation for the business now and going forward? Of course, this was one of those businesses that really benefited during the pandemic, when parents were at home and had to entertain their kids. Do you see that continuing?
I think Disney is a great company, but I'm a little hesitant over the next little while, which is really the case with a lot of companies given the macro risks. So we've seen many estimates basically saying that this year, i.e. 2020, will be the peak losses for the Disney Plus division, because it's actually ironic now that you have Netflix as the one that's making money and streaming, and everyone else is losing money. But anyways, so that part of the business is expected to be at the worst profitability picture this year. But that assumes that spending is under control and that content costs don't kind of surprise to the upside. So that's one part of the question here. And then the other side of the equation is that, given that Disney's not making money on the Disney Plus side, and the linear networks, the more conventional classic TV networks and traditional advertising is kind of in a slow decline, what you're left with, the ballast of the company, is really the parks business, which generates a ton of profitability for the group as a whole. And while we really like that business, that is certainly not immune to an economic downturn. I think it's fair to say that if the global economy continues to slow down, specifically in the States, then that could be a problem for Disney. That is the profit center of the business, right? Especially as the DTC business kind of tries to inflect towards profitability. So that could create a tricky picture here. Now, all that said, Disney is a great company, amazing assets, amazing content, amazing synergies between businesses and whatnot. But it might be tricky in the next little while. That would be my comment.
Okay, we've got an email question now from Max about healthcare stocks. I want to add a big healthcare stock to my portfolio. Would you pick AbbVie or Pfizer?
Right. So I'm not a resident healthcare expert, but our healthcare experts in-house prefer AbbVie over Pfizer. I know the news today is definitely with China kind of finally accepting mRNA vaccines. That's certainly positive there. But I think just as the core at a core business level, our team likes AbbVie better. I think the core cancer side of the business is expected to kind of grow on its own. And you also have exposures to the aesthetics business, which I think is really promising over the long term, but is definitely exposed to, it's definitely a cyclical business. So all that's to say, really, this comes down to the core business. The core business is outside of COVID and related, which we don't think is really kind of a perpetual income stream. So our view is really that Pfizer over the long term will likely have to grow by acquisition, which carries or complement its own internal growth with acquisitions. So there's obviously execution risk there, valuation risk, et cetera, whereas AbbVie's core franchise can kind of allow the company to grow on its own and kind of stand on its own 2 feet.
Welcome back. Let's take a look at some of your past picks from November 10th, 2021. First is Block. Of course, it just reported its Q3 period. Now, over that time, we've just seen news that it posted a slight dip in terms of its Bitcoin profits. Do you think that this was a business that was the right move to let go of or to hold on to?
So let me just start off by saying that these past picks, which were not great, let's be honest, were made pretty much at the peak of high growth. So one proxy to look at would be like the Wisdom Tree cloud computing, which includes a lot of high growth stuff, and that peaked around the same time. So it's disappointing, obviously, to see companies like Square down as much as they have been, but that's just been how the market has been. So Square, we exited the name a while back. I think it was in February after taking some losses. And I think that this is a company, the fintech area, I think is a good one, but I don't know if it's the right time to be owning a company like Square. If you share our view, which is that volatility is likely to persist here because of how the economic situation is evolving or devolving, then do you want to own a company that's still expensive? After the massive drawdown that we've seen, this company is still expensive. And so with Square, they have the initial reasons that we were interested in it, because it has kind of two different ecosystems that could eventually work towards sort of a closed loop. So you have the consumer cash app business, and then that's where some of the Bitcoin that you were talking about would fit into. And then you also have your seller economy, which is tied to small and medium-sized businesses and seller services and whatnot. And so all of this together, I think, will let the company succeed over the long term. But I just don't think now is the right time to be owning Square.
Okay, next one.
Even though yeah, sorry.
Sorry, go ahead.
Well, I was just going to say the results were better than feared, so that's good, but
Okay.
still not interested.
Right,
yet.
and it's just the time of the market as well. I mean, we've seen that with tech peers in the same space on the TSX. So now let's move on to Meta and where you stand on the business. Look at that total return down 73%. It hasn't been a good year for Meta and its peers as well.
So with Meta, I've been trimming positions pretty much the entire year. I do still own some. So I will say it's been an unmitigated disaster. It's been one of potentially the greatest destruction of capital that's been done by a CEO. But anyways, wow. I digress. So let's talk about the positives first. Okay. So this company is dramatically undervalued right now. And it has been undervalued for a while. So, timing is always something to consider. But we think that some of the concerns around the company are overblown. I'm going to talk about the metaverse in a second, but let's talk about Facebook as a group of applications. Facebook Blue, Instagram, WhatsApp has nearly 3 billion daily active users. 3 billion.
Right.
That's pretty amazing. And to think in any possible situation that Facebook is going to disappear, because we hear a lot of people saying, okay, core Facebook is dead, Instagram is past its peak, WhatsApp, et cetera. Maybe so. I wouldn't necessarily agree, but the point is that for this to disappear from the face of the earth like a MySpace, that's not going to happen overnight. This is a company that has true staying power. And then on the TikTok side, I think TikTok has harmed Instagram's growth, but Instagram is still showing growth potential. It's had weaker growth because of TikTok. So we'll see what happens with the whole regulatory environment. And then just one more point I wanted to make. I think part of the reason that it's been bad so recently since earnings has been because of the spending intentions, right? We're in an environment where people want to see protection of profitability, margins, et cetera. And Facebook came out and said, okay, well, we're going to spend even more money. But if we look at where that money is going, the CapEx in particular, that's mostly funding the company's AI efforts. And I've been on many times talking about how I'm a true believer in AI, and with Meta specifically, when you came into those targeting issues that resulted from the Apple privacy changes, you have to find ways around that. And part of the way they're going to do that is with artificial intelligence. So spending in order to support the continued development of the AI that underpins all of their products, that's fine. Maybe the scale of the spending is a little bit scary, but I think that's the right thing to do, maybe not to that extent. And then on the metaverse thing, we are not really true believers in this yet. And I think part of the issue is that Zuckerberg is such a believer that this is going to turn out the way he thinks it does. But we think he should have a little bit more humility and listen to what the market is saying. What are the sales telling you about the potential of this? What are people saying, aside from in Zuck's head, the potential of this market? Is it really as big as he thinks it's going to be? So that is an overhang here, but I do think, coming back to the initial point, it's been disappointing, but it's clearly very undervalued, and it's still a great platform of applications. We can't forget that. Unfortunately, we have this side, it's not even a sideshow now because the company's named Meta, but you have this side part of the not the non-core business eating away from profitability at a time when the market wants to see profitability.
Great.
So.
Let's squeeze in your last pick, Airbnb. Speaking of sort of these wider market fears, including just purchasing power disruptions, how has it impacted the business? Look at it, down 52% over just the course of a year.
So this one, again, and this is a name that I believe we've exited in April. We see the long-term potential here, but I think the part of the main issue is valuation, right? Right. Alternative accommodations. So basically to say places to stay when you're traveling and experiences outside of a hotel, that's here to stay. People really like it. And that's going to, we think, contribute to the continued growth of the company. And as they layer in more experiences and other kind of complementary services, that should lead to higher profitability. But it was expensive and it's still not terribly cheap. And then on top of that, I think all you need to know with Airbnb this year and how the market perceives it is that we've seen very strong indications for travel spending, whether it's through the credit cards or whether it's through the Expedias and the Bookings of the world. And still this stock has had such a difficult time. So what happens to this name if travel spending gets curtailed, which we think is totally possible if the economic situation deteriorates. So this is another name that we will keep on our radar, and we think that it's going to be the winner in the market for alternative accommodations, but it's probably a little bit too early right now.
Okay. Finally, can you leave me with, we're getting news that, NASDAQ is down about 40% over the course of the year. What is it going to take to sort of buck the trend that we're seeing for it?
For the NASDAQ, it's
the index, yes.
Oh, the index, yeah. Well, tech has borne the brunt of the macro headwinds that we've been facing this year. And if you think about what have been the core drivers of all returns this year, it's been rates and inflation. And unfortunately for tech, and especially with some of these names, like let's use Square and Airbnb as an example, when profitability is further out in the future and the market is giving you credit for things that are not going to happen in the immediate term, and maybe those aren't the best examples, but I think you get where I'm going with this, with high growth companies. That is the concept is kind of equity duration, which is a familiar term to fixed income investors, which would be to say the maturity of a bond, the longer the maturity of a bond, the more risk that's embedded into it as a function of that timing. And so you have the same phenomenon in equities in a way. So tech has a lot of long duration assets. And so with rates going up and then also with inflation potentially hurting margins and especially on the labor side and whatnot, it's kind of a perfect storm for tech. So the reverse of that is when we can finally have some comfort that the rate hiking cycle is over. Right. And inflation is starting to come back down in a meaningful way, because we're still very far away from a 2 or 3% bogey. So those things will help a lot.
And that dovishness is what the market is definitely waiting on tenterhooks for. Let's get back to our callers. We've got Walter in Hamilton on the line. Walter, what's your question?
Good afternoon. Thank you for taking the call. Nothing lasts forever. So if we are entering a phase of slower cloud growth, where would that leave a company like Accenture PLC? Are its best days in the rearview mirror? Thank you.
Okay, I didn't hear you too good, but I think you're saying cloud growth and then Accenture.
Yes, exactly. Right? He wanted to know, are the best days for this business behind them or ahead?
We saw an interesting, there's a lot of these chief information officer surveys that are put out by some of the sell side. And one of them that we saw actually interestingly said that the first thing to get cut in an economic downturn is consulting spending. So with that said, we still actually do own a little bit of Accenture. It's a good business. I think if the economy is still humming along, it's a good name to own. And sure, there's definitely some exposure to cloud and as well as many other growth areas. But I do think this is one that we are very cautious on given our views on the economy. So a good name, but definitely a cyclical business.
Okay. Next, we've got a caller, Jerry, on the line from Lindsay, Ontario. Jerry, what's your question?
Yes, good afternoon. Shane, early in the commentary, you indicated that there will be some stocks that maybe we shouldn't be buying right away. I've got a question on Microsoft. Is now a good time to buy it? And if not, then do you see that we're going to have a long recession in front of us or a short one? Anyway, I'll hang up and listen to your comments. Thank you.
I think everyone needs to think about their different circumstances, obviously, in terms of what investing needs, what you want investing to help you achieve. So that's the first thing to say. The other, and part of that is time frame, right? I like many other people in 2022, I find myself very focused on the near term because it's been such a headline-driven, volatile market, right? But if we zoom out and we think, what are these companies going to look like in 5 to 10 years? I think Microsoft is one of the best companies around. So one of the things that's really spooked the market recently has been a deceleration in cloud computing growth. It's disappointing, but not entirely surprising. Like it's a secular growth trend, but it's something that's not impervious to a slowdown. But we think this is a cyclical, and this is a part of a larger optimistic view on the market itself too. This is kind of a cyclical slowdown within a broader uptrend. So I would say that for Microsoft and cloud computing, and hopefully the market as a whole. I think once we can trudge through this, there should be multiple years of solid gains ahead. So that's a very long-winded way of saying that Microsoft is great. It's a great company. They have a good cloud franchise. They're fully kind of embedded in our lives through Windows and the Microsoft 365 suite. So it's a very well-run company, and I think over the long term, there's not much to worry about.
And it's got that
just the next little while.
With a wide moat status for a number of analysts. Next, we've got William in London, Ontario. What's your question?
Thank you for your funds that we have bought and done very well with.
Look at that. The ultimate compliment.
I own Google and Apple. I'm thinking of selling some of my Google and buying more Apple. Do you have an opinion, please?
Yes. Well, thanks for the support. Number one, I would say I was just talking to one of my colleagues about this. So Google now is trading at a forward valuation. I think it's like 13.5 times, something like that. The lowest in its publicly traded history was 12.4, I believe, in mid 2012, I think was anyways. So Google is getting to the point where it's so cheap that it's almost unbelievable. Whether or not we go into recession or we don't, and how long the recession is and whatnot, ultimately we're looking for what is pricing in the worst case scenario. And I think Google is rapidly approaching that. So to put in perspective, Buffett, who was known for staying away from tech, and granted, this was probably partially his decision and partially some of his lieutenants, when they first bought Apple, it was trading, I think it was Q1 of 2016, it was trading between 10 and 10.5 times on a forward PE basis. And so Google is not quite there yet, but it's pretty close. So that's the Google side of it. And I think anyone who's seen me on the show knows I love Google. I also love Apple, but if you were going to do a pair trade, I would actually consider it the other way around. I would consider maybe paring back on Apple and buying more Google because Apple is a little more expensive. And the one caveat that I'll have here is that Apple has a tendency to outperform in a late cycle environment, kind of like what we're in now. So that is a point, but I did notice, kind of looking at just recently the drawdown in some of these mega cap names, and seeing Google's valuation where it is pretty remarkable.
We've got Henry on the line. Henry in Markham, he's got a question. What's it?
Hello, I'd like to know about AT&T, your long-term outlook, 5 to 10 years.
Okay, great. Yeah, thanks for the question. So telecom, U.S. telecom has been pretty bifurcated this year. So you've seen T-Mobile as kind of the standout winner, and then AT&T's done remarkably well, and Verizon has really been the laggard. But these companies, and this is coming back to, again, everything related to interest rates, if you think rates are going to go higher, then these are companies that you'd have to be a little more concerned about, because they're highly leveraged, and they're effectively bond proxies, right? So AT&T, I think you have to give them credit. Following kind of the closure of the Warner thing, which was really an unmitigated disaster and maybe one of the worst acquisitions in the history of the stock market. That's now gone, and now AT&T can focus on being a telecom company, and it looks like it's working. So their numbers have been good. The dividend is obviously quite attractive. The valuation is attractive. We'll have to see. I would continue monitoring it for leverage to come down, but we think that there's potential for that to happen as CapEx kind of peaks out on a year-to-year on a absolute basis, which should drive free cash flow higher next year. So I think it's probably a decent long-term hold. I do think these companies have some issues, and I would not expect something like AT&T to outperform the market over a long time, over a 5-year time horizon. But we do think that the dividend is increasingly protected by the fact that the company is becoming more and more profitable. So it's not my favorite, but I think it's pretty reasonable at current levels.
Time now for top picks. Let's start with Amazon. Of course, today, if we take a look at the stock price, you can see it had a little bit of a bump actually on the back of the better than expected jobs data, but cratering overall. Look at that, over a 1-year period, down about 47%. Has your investment thesis changed at all given the better than expected results today in terms of the health of the U.S. economy?
No, it hasn't changed. I think one of the difficulties in the current market is trying to identify or discern between macro risk, and so a slowing economy, and then company-specific stuff, right? And with Amazon, the story remains pretty clear to us. And I think at current levels and with valuation compressing so much, it's really hard to see and I can't make any promises, but it's really hard to see how an investor can't make money on this on a longer term time horizon at these prices. So Amazon is still the leader globally in e-commerce. They're still the leader in cloud computing. These are two powerful secular trends that are going to continue on their path regardless of what happens with the economy as it goes through its normal course cycles. So those are powerful drivers. And then I would say with Amazon particularly, the irony is that it's been punished. I think part of the reason the last quarter was ugly, but part of what scared investors, I think, was margins came in, operating income came in a lot lower than people had expected. And because Amazon's running at pretty thin margins, any kind of hiccups on the profitability front really scare people.
Right.
But I think that doesn't really affect the viability of the company, the long-term viability here. They're a good company. They're going to figure it out. AWS and advertising continue to grow faster than the retail business. Those are both more profitable divisions. And as Amazon basically spent so much money during COVID building out their fulfillment network, that's not going to continue on indefinitely. So when that CapEx kind of moderates, all of those things together should lead to like significantly higher profitability for this company. And so at a time when people want profitability now, it seems a little tricky, but this is going to inflect, we think, in a major way over the next few years.
Okay. All right. Now, the next one is PepsiCo. This, for some investors, feels like a very expensive stock. I mean, estimated forward earnings is about 26 right now. Where do you stand on the business and sort of its viability as we have more macro headwinds moving forward?
Yeah, I think depends on what forward metrics you look at. I think we're more in the lower mid to lower 20s, but instead of 26. But either way, staples are expensive. There's no two ways about it. But people are paying up for stability. And I think Pepsi has done a great job in the current environment. If you look at the last earnings report, the amount of pricing that they pushed through is almost unbelievable. And we think going forward, there's no way they can repeat that again. So organic sales growth, what we're going to watch for is that needs to come from a combination of slight price increases and then also volume growth. And Pepsi is in good categories. I mean, it's a name that everyone knows for soft drinks, but we were on a call with the management recently. There's not even a mention of soft drinks. This is a company that's now become much more reliant on the snack business, and I think snacking is like a phenomenon that's going to continue. You know, people are busy and they want quick fixes and whatnot. So the Frito-Lay business is really exciting. The Quaker business is not as exciting, but the point is that you hardly hear as much about soft drinks. They were really focused on the snacking business, and they're focused on non-sweet drinks, the Gatorade and even potentially like the seltzers and whatnot that they can put out with some of their partnerships. So these growth areas are not what I think people know the company for as a brand name. So I think there's a lot of drivers that can help this company to continue growing sales for the next few years. Organic sales growth 5% with continued productivity gains. So cost control programs, we think they can do high mid-single digit EPS growth for the next few years as well.
Okay, we've got about a minute to go. The last one, Deutsche Telekom. Tell us, where do you stand on this business and why do you think it's got prospects for growth?
Right, so Deutsche Telekom, I'll just shameless plug here. This is one of the names in our global dividend fund. So one thing that we think we can add value for investors is to buy securities on foreign exchanges. And so this is an example of that. So Deutsche Telekom is a German telecom company, hence the name. But it's actually an interesting story because the main value proposition behind this company or the stock is that it's the majority shareholder of T-Mobile. And T-Mobile is what we think is by far the best 5G network in the States, and we think they're the best position to continue growing from the rollout. And so Deutsche Telekom is a way for us to access that growth while also getting paid a decent dividend in the meantime. And so the company is very attractively valued as well. I would say lastly that at current valuations, the ex-US business is effectively valued at nothing. So you get that for free.
Thank you so much for all of the advice, Shane Obata.